Well, yeah. So we've got an experienced team here to support you and answer any questions that you have. Kathy, thanks for having us or inviting us to be on the call with you and your team here. Before I get started with our presentation, let me just open it up to all of you to find out what's really important for you in this presentation. So I've got some information that I'm happy to share with you, but I want to be sure that we're covering what you really want to cover. So Kathy, do you have anything you want to say first?
No, I'm fine.
I had to get myself off mute there. I'm sorry. Can you guys hear me?
Yep, you bet.
Yes.
No, we don't have anything else to add. They are, they do a lot of purchase business out at Easy Qualify, so they're just interested in all the different ways that they can help their borrowers using MGIC. So I think they're interested in all the different, split MI and the differences and benefits of each. Everyone kind of needs a refresher on that, I think.
Okay, great. Well, we will absolutely do that. Rich, is there anything that you have in mind specifically, or should we just get going?
For me, just going over your different MI programs is fine.
Okay, perfect. So, as you can see from the title of our presentation, we're going to really talk about mortgage insurance and what opportunities it offers you in today's market. We will cover some of the basics, but what I've found is that the majority of loan officers out there actually know a lot about mortgage insurance these days, and maybe just do need a little bit of a refresher course and need to understand a little bit more about what each of the premium types offers to them from a benefit standpoint. Before we get started, I just need to remind you that, or let you know that our legal team will deny I said anything, that this webinar ever took place, and that the internet was ever invented. So really, that's my disclaimer today. But hopefully in the next half an hour or so, or I'm going to go through this pretty quickly, we will explore some opportunities that you have in today's market. And there have been a lot of changes, but there are still lots of opportunities, and there are ways that you can really differentiate yourself by working with MGIC and with Pinnacle in today's market from your competitors. So hopefully, as we get going, please don't hesitate to ask questions. I'm here, we've got a pretty small group here, so like I just ask me what questions you have. But as you know, in today's market, borrowers really are looking for somebody who can be their trusted advisor. They don't shop rate so much, they shop for loan officers. And the good news in that is that it's harder to get a loan today than it was 6 years ago. That's really the perception that borrowers have. Now, of course, you could argue that it's not harder to get a loan today than it was 2 years ago, but it certainly is harder today to get a loan than it was 6 years ago when they barely needed a pulse to get a loan. What that does for you from a good news standpoint also is that it gives you the opportunity to really differentiate yourself as their advisor and as a mortgage professional. So it's very important for you to really understand and be able to explain to your borrowers what their mortgage options are. When it comes to mortgage insurance, of course, I could go on and tell you about MI and what the history of it is and why we have it. But I know your borrowers really don't want to know that, and I'm here to be your expert. So hopefully we can give you some tools to help you understand what opportunities are out there. There are opportunities in today's market, even with rates going up. I think that there's an opportunity to tap into the rental market. 7 out of 10 renters want to be homeowners, and that's a great opportunity for you to start working with the purchase market. Of course, it sounds like you already are doing that, and you're looking for new ways to explore that. Of that 75% or 79% of renters, actually 64% have aspirations to be homeowners in the very short term. And if if you take the younger segment of that business, 93% of them, young renters, want to buy soon. So you can really ask the question, well, why aren't they? A lot of potential home buyers, those renters out there, think that it's really tough to get a mortgage today. Some don't qualify, of course. They have, debt that they can't get past. They don't have the FICO scores that they need, or they don't have a source of down payment. But if you look at what the statistics are on FHA loans, which is 79% of all FHA purchases in August of last year were actually first-time home buyers. And so I think that you can see there's a lot of opportunity out there as the market changes for home buyers to come into the market. Now, we've seen a lot of changes with FHA, of course, and I'm sure you're all very aware of them, but the rates for FHA continue to go up. We saw that the last rise in rates happened last April. I think that was impactful and started moving some business toward the conventional market. But one of the game changers that I saw was on June 3rd when the FHA removed the ability to cancel mortgage insurance unless the borrower put down 10% or more. And of course, so we've seen a gradual migration over to conventional lending. And the good news in that is that MGIC has really opened up its ability to insure those high LTV loans. We rolled out our GO guidelines over a year ago, and it really makes things very easy for you to get mortgage insurance on your loans all the way up to 95% LTV. We do allow up to a 105 CLTV and credit scores all the way down to 620. We allow up to 150 cash out, and you can see that with that, most loans are going to fit right into that. We will follow findings. So you will follow findings for your debt-to-income ratio, your gifts, trade lines, reserves, blended ratios. We don't have any overlays on flip properties. The only thing to keep in mind is that we do not insure investment properties or 3 to 4 unit properties at this time. And the other thing to keep in mind is if you have a condo, are you guys doing condos at all? I'm going to assume that you are probably doing some condos. Just double check to see if your condo project is on our ineligible project list. If it is on our ineligible project list, it does not necessarily mean that we can't insure that loan. It does mean that you need to get in touch with me or with Kim so that we can help you navigate through that. It's not a difficult process most of the time.
Is your list a different list than what's on the Fannie Mae website? Or you guys have stuff that maybe overlaps on that? Okay.
It's smaller than the Fannie Mae list. So if you go on to MGIC.com, and we will toward the end of the presentation, I'll show you where that is. We really don't have that many ineligible projects in the Bay Area, but there are a few. So it's just something to be aware of that we would have to go through a little bit more process if it is on the ineligible project list. But like I said, it doesn't necessarily mean it's DOA. So just give me or Kim a call. The guidelines aren't the only thing that are changing. As a matter of fact, we just recently dropped our rates. They went into effect on December 2nd, and that really helps you expand your market and qualify more borrowers for a high LTV loan. At the end of the day, though, what is mortgage insurance about? Well, for the lender, for Pinnacle Capital, it's a financial guarantee against loss in the event of a foreclosure. Borrowers probably don't care about that, but lenders do, and that's why if you have an LTV above 80%, you will have some sort of credit enhancement one way or the other, and that's a good thing for the community at large. For realtors, mortgage insurance offers the opportunity to have a wider span of borrowers, accessible borrowers, And also it helps them qualify borrowers for, or bring borrowers into better neighborhoods, or maybe even help them qualify for a bigger house. But borrowers probably don't care about that so much either. They just want to know that they're going to be able to get into the home that they want. So this is where you come in. You can help them understand that for the borrower, MI gives them the ability to get into a home much sooner than they would be, or they would be able to if they had to come in with 20% down payment. And it's not going to be a root canal to get it. So one of the things that I always try and cover, and this is kind of in the MI basics category, but to understand how mortgage insurance works gives you the ability to explain what it does and what the benefit of MI is to the borrower. Here in this slide, we have two examples. One is on the left-hand side, we have the same property, both sides, $200,000 property. We have a 10% down payment of $20,000. On the left-hand side, we do not have mortgage insurance. So what that means is that if the borrower were to go into default, the lender would be on the hook for $180,000. That means that they have to recover $180,000 in order to be whole. On the right-hand side, we have the same property, 10% down payment, with mortgage insurance. Now, the agency set, or the servicer sets what coverage requirements needed. For a 90% loan, 30-year fixed conventional Fannie Mae type of loan, 25% coverage is required. What that means is that in the event of a foreclosure, MGIC would write out a check for $45,000 to Pinnacle Capital. That reduces their exposure to $135,000, which is 67.5% versus 90% on the left-hand side. It's much easier for a lender or a bank to recover that $135,000 than it would be for them to cover that $180,000. Now, that's a really simplistic example because there are a lot of costs associated with a foreclosure, such as attorney fees, cost to cure, back taxes, interest. There's a lot of costs associated with a foreclosure, and mortgage insurance really helps mitigate those losses for a lender. So it's a great tool, and it gives banks the comfort to know that they are not on the hook for it. Now, there's also a lot of confusion right now on QM and what that means when it comes to mortgage insurance. The good news is that it really hasn't meant anything. We haven't changed much at all. We still offer every premium type, and none are illegal. You just need to be conscientious of what is included or not included in your 3% points and fees. So I have, Kathy, I think you have a copy of this flyer, but if you don't, I'll forward it to you. In a nutshell, 95% of all the premiums that we issue today are excluded from the 3% points and fees. That includes borrower-paid monthly MI and lender-paid MI. So you can take those out of the points and fees. They're not included. That's the vast majority of all MI that's issued today, and move on. The other premium types, such as borrower-paid singles, whether they're refundable or not refundable, and split MI, are included in the upfront 3% points and fees. So I can forward that to you. But as I said, all of the premium types are still available. And I think through Pinnacle, you have a unique opportunity because a lot of lenders right now are limiting their MI premiums to single LPMI and to borrower-paid monthly premiums. Now, that said, the benefits of monthly MI are that there's no money collected up front at close of escrow, and it is cancelable. And I'll talk about MI cancellation in just a minute. Single premiums can be paid for by the borrower or by the seller. They are still considered a borrower-paid single and would be counted toward the 3%. Lender-paid MI is available, and it would be the cost of the MI is generally included in the rate. And the one thing to keep in mind about LPMI is that it is not cancelable because it is included in that rate. So when we're in a rising interest rate environment and we know that the borrowers are going to be in that loan long term, it might be something to consider or to talk to them about, whether they want to have a higher interest rate for the life of the loan or whether they want to have monthly with the ability to cancel it maybe as soon as 2 years down the road. So those are some tools that you can take out there and really help put the options in front of a borrower to give them the, whatever options are best for them. I like split premiums. I think they're pretty cool because they're kind of a hybrid between monthly and single premiums. The upfront portion of the split premium can be paid for by anybody. It would be counted toward the 3%, however. But with, by putting an upfront portion of the MI down, kind of like FHA, you would have a reduced monthly renewal rate. That renewal rate is cancelable. So you get a little bit of, both worlds, the best of both worlds when it comes to split premiums. Just keep in mind that you do have to count the upfront portion toward the 3%.
I had a quick question.
So with that, let me, I was going to open it up for questions. Go ahead.
Okay. Do you know, by any chance, I know 2013 the mortgage insurance was deductible. Do you know if the upfront MIP, the upfront premium, do you know if that part is deductible?
Yeah, actually, we don't really know yet what the MI tax law is going to look like this year because it hasn't been passed or declined. That's not really unusual because we've had a lot of years in the past. As a matter of fact, I'm trying to think, 2013, I don't think we had word on the tax deductibility law until mid-January of 2013, which made the MI tax deductible for 2012. So for all of 2012, we really didn't know whether it was going to be tax deductible or not. I think we're kind of in the same holding pattern right now with the law. Now, keep in mind, when it comes to tax deductibility, there are some income limitations. So what the law says is that if you make $100,000 adjusted gross income, you can deduct 100% of your annual MI from your taxes. What that means is that you take whatever you paid for MI for that 12-month period, you multiply it by your tax bracket, and you divide that by 12. So it really doesn't wind up being very much. On a single premium, that portion has to be amortized over the life of the loan. So, or I should say down to the coverage, so down to 78%, so you'd have to amortize it. Now keep in mind, I'm not a tax advisor. I don't think any of you guys are tax advisors, so we want to be very conscientious about giving the borrowers tax advice, but they can certainly talk to their tax advisor. And as that law gets ratified or not, I will certainly be in communication about that.
Right, because
Does that answer your question, Rich?
Yeah, because I think a tremendous advantage, like last year, would be if they pay the whole MI up front, then they get this write-off because the other years aren't guaranteed. So that's what I have been selling a lot of the clients on.
Yeah, unfortunately, with single premiums, they can't deduct the whole amount at once.
Oh, I
They
see.
have to amortize it.
Over 30 years?
Yeah.
Okay.
Well, it's down to 78. It's for the term of the coverage, I believe. So, double check with a tax advisor. But, Kim, do you know?
No, I would agree with you. I think it has to be amortized, and I thought it was over the balance of the premium, so just 78.
Yeah, I think it's down to 78%, which is the term of the coverage. So we can find that out for you, Rich, but I think that's... And right now, we don't have tax deductibility, so it's sort of NA for the time being.
Okay, got it.
So that's a great transition or segue into MI cancellation. So thank you for that setup. MI cancellation is probably the most common question that I get from loan officers. And I know that you want to be very comfortable in explaining it to your borrowers. So I think the easiest way to explain MI cancellation is that, first of all, the MI companies are not the ones who cancel the MI. It's really the servicer. They are the insured. We are just the provider of the insurance. That said, there are two ways to cancel mortgage insurance. The first way is through the law. It's called automatic termination. And what it basically says is that once a loan amortizes down to 78% of the original value, the MI must be canceled by the servicer. So there's really no equivocating about that because it's the law. With borrower-initiated cancellation, there's no law surrounding that. However, you can keep in mind that most servicers follow agency standards, which are 2 years payments as agreed and proof of 20% or more equity. I've got a really nice brochure. Like I said, we'll go out to my website in just a moment, and I'll show you where that is located that you can share with your borrowers to help them feel comfortable that you're going to be there to advocate for their, for the MI cancellation. Now, of course, if it's LPMI, it's not cancelable, but if they have a monthly premium, that's a great way to help them stay in a really low interest rate and be in touch with them long term. So you can build your relationship with that borrower, help them drop their payment in the next few years. And of course, values are appreciating, so they may hit that 20% mark pretty quickly, but most servicers do want to see 2 years payments as agreed. So are there any questions about that? Usually I get one or two. Nope. Okay. Of course, we know that interest rates are likely to rise. As a matter of fact, we expect them to hit 5% probably toward the end of 2014. And what that does is it really, it's kind of a ceiling for borrowers who may want to become homeowners. And you can encourage them to get into their home now and maybe below that threshold if they're nervous about that 5%. Now, we may laugh about 5% because I'll bet there are some people on this call who remember when they were 8 or 9% or even maybe the 17, 18%. I get that once in a blue moon. But here's an opportunity for you to tap into some of your past clients and really encourage them to kind of get off the dime and become homeowners. So if you have a past, a database of past clients who might have adult children, encourage them to help their children become homeowners by giving them a gift for down payment. As a matter of fact, about over 30% of first-time homebuyers had help with the down payment. I see them all the time, and I encourage you to take advantage of that. So spin things in their favor with a gift. Fannie Mae allows 100% of the down payment to come from a gift on all of their products. Freddie Mac allows it on Home Possible. And so it's a great opportunity for those former clients who might have adult children to help their adult children become homeowners. So with that, I'm going to take you out to our website, and let me see if there's any questions that you might have right now. Are there any questions? No? All right. I'm going to take you out to our website. This is the MGIC website, and most of the tools that are available on here do not require a user ID or a password. So you can see here that we have our rate finder. That's a really easy way for you to know that you are providing the best rate for your borrower. Go out here and you just enter the loan information. Most of it you'll have, and it will actually, it'll remember what your last scenario was. You can click on Get Quote. You can run a bunch of different scenarios, print that off, get in your file, and I know Pinnacle will honor that. I mentioned to you earlier the cancellation, and there's a brochure posted here called When and How to Cancel Mortgage Insurance. I think this is a great thing to share with your borrowers. You can, if you need hard copies, I'll be happy to provide those to you. I can send you a couple of 100 copies or however many you need, or you can just save it as a PDF and email it out to your borrowers. Now the other thing, comparison calculators are available to you. And if you are talking to your borrowers about an FHA versus a conventional, I think this is a great way for you to differentiate yourself from other originators out there. And I'm just going to run a scenario here because I want to demonstrate what a great tool this is for you in illustrating the point. So let's just do, let's see, we had a $200,000, oops. We had a $200,000 example before, and I realize that's low for the area, but we'll go with that anyway just for example purposes. We'll do a 740 FICO, although we'll insure loans all the way down to 720, and we'll give a modest 6% appreciation rate. There were a few years where I kept getting asked, can we put negative numbers in there? I'm so glad we're not in that right now. And we'll just do a 95 versus compared to a 95 FHA, and that's just to keep apples to apples. We could actually do a 95 to 96.5. They usually are pretty similar in terms of outcome, but the down payment on the conventional would be higher, of course. And we'll adjust the interest rate. What's an interest rate right now for a conventional 95? About 4.5.
Probably 4.5.
4.5. 4.5. Sorry. Good.
Okay, that's fine. 4.5. I'll do 4 1/8 for the FHA. Uh-oh. What happened? Did I lose you guys?
No, we can see your
I'm
screen.
still here.
Okay, good. I lost you for a second.
Harper, can you just clarify for us when you were going through the credit scores? You said you could go all the way down to 720. Did you mean 620?
620. Yeah, 620.
Okay.
Sorry about that. Now, what I like about this comparison, and I think that this really does a great job illustrating what the benefits of going conventional versus FHA are. You can see by the check marks what is going to be most beneficial to the borrower. Of course, there's no check mark next to down payment because they are the same. And you can see here on our comparison calculator that we not only look at what their loan looks like day 1, but we also take it out year 2, year 5, and year 10. And I think that really can show your borrowers what the cost of the mortgage insurance on a conventional versus an FHA are. So you can see here the cumulative MI costs on an FHA loan are almost 4 times higher than that of a conventional loan. You'll also be able to see how many months are required on that mortgage, or how many months they'll have until they're likely to amortize down to that 78% point and cancel their mortgage insurance. So in this particular example, it would only take them 39 months before their rate dropped, or their payment dropped. So you can, at that point, save, email, or print that tool. And this is what that looks like. It's a really nice tool to have to show to your borrowers and even use it in open house. So if any of you are doing open houses, I think that's a great opportunity to show your realtors what options are available to their potential borrowers.
Now the MI factor.
There are some.
Quick question: the MI factor that was 0.6, was that auto-calculated? So does that tool is also a calculator? Is that tool?
Yeah, it's not so much a calculator because it will use the borrower paid monthly rate, so you can't really do a single premium on that calculator. But we'll go out to the rate finder right now, and I'll show you what the rate finder looks like, because I think that's if you're looking at a calculator. Are you looking for a way to do a side-by-side comparison?
No, I think it would be awesome if that was also if that tool also calculated that 0.6 factor. Did it? On the
it does not. We have one of those. Yeah, so thanks for asking the question. Hold on, let me see if I can get back out there to this. Go back up to the comparison calculators. Hold on.
Which one? Again, Joyce.
Was there a question?
No, I'm sorry.
Viviana?
Oh, that's okay. So there's an MI options calculator if you scroll down in our comparison calculator page where it allows you to do a side-by-side comparison of 4 different options. So in this, we've got sort of a standard example here of a $250,000 loan. Actually, that's probably an example that I used with a 90% LTV and 760 FICO. I'll put in 95 just for kicks and giggles. Oh, you know what? I'm not going to because that would mess up the scenario. Never mind. Now, what you can do here is select which loan options you want. So let's say we want to do monthly MI. It will auto-calculate the MI premium for standard agency MI coverage with MGIC on that. We'll do a split MI as our second choice. Oops, it's going to ask me for our interest rate. We'll do 4.5. We'll do 1 point up front. That's usually what I see the most. So you can see that this is, we've got some standard selections here that you can monkey around with that. We will do FHA. And our last option, we can do LPMI. And we'll increase our interest rate to 4 7/8 to account for the LPMI. So I think, yeah, let's the interest rate off that, 4.5. So I think this is another great tool to show your borrowers some options that they have. You can email this out to your realtors. You can have this at open house. Keep in mind it does not have APR on here. So I wouldn't use this as a marketing tool because I don't want you to be out of compliance. But it does give you a great way to illustrate the different options that are available to your borrowers through you and through Pinnacle.
So a quick question. I don't sell a lot of the LPMI. Is that basically going into the Pinnacle's pricing engine and then pricing out the LPMI product?
Yeah, I think actually, Cassie, you guys break it out separately, don't you? Your LPMI product?
I'm sorry. Do we list what out separately? Pricing for it?
Product? Yeah. So do you have a separate section on your rate sheet for LPMI?
Yeah, we have a section on there to tell you what the price and adjustment is to the rate. And yeah, it's pretty easy. It's just an adjustment to the rate. You're going to pay a higher rate for that.
Yeah. Yeah. So Rich, I think to answer your question, you wouldn't have to go out to our rate sheet to find out what the cost of that MI is with Pinnacle. You would just use their LPMI section on the rate sheet. Okay,
so that's where you got 4.8. All right, great.
Yeah, I just went off of what the average adjustment is for LPMI, and usually it's a quarter or 3/8 to the rate. Now, keep in mind again, that may benefit some borrowers, and it may help them qualify, which is one of the benefits I think of LPMI. However, it's not ever cancelable, so you would really have to talk to them about, okay, you can have 4.5 or 4 7/8. If you have 4.5, you're going to have a monthly MI premium, and we can cancel that down the road. With LPMI, it's going to be a little bit higher, and it won't be cancelable. But
so with LPMI, though, there's cell phone or somebody might have put on hold. Yeah, everybody.
all right, there we go.
All right.
Well, can you unmute just me?
Yes, you're unmuted. I just
okay.
Yeah,
Because I know. Putting on. I think that with LPMI, correct me if I'm wrong, Harper, but when they get their mortgage payment coupon, because we've actually built it into the rate, isn't LPMI done in the background? They're not going to see an additional amount on their payment coupon that's for MI, right?
That's correct. Yes. Yeah, they won't be able to deduct that from, they won't have it as a tax deduction. It won't be a separate item for MI. So you're right. It's not going to be, a tax deduction. Now, you could argue that they can write off the interest, and that's true. They can as mortgage interest. But it'll be, I think that's kind of that's the selling point is you can talk to them about either reducing their payment in the next couple of years for the life of the loan, or taking the tax benefit and having that higher mortgage payment because they have a higher interest rate.
Does LPMI usually come out cheaper?
Does that help?
Yeah, does LPMI usually come out cheaper than the other MIs? Because it seems like this one.
Yeah, it kind of depends on how Pinnacle is pricing it, and usually what I see is that the lenders have done a kind of a cost averaging. So it really just depends on what your scenario is. Sometimes it is cheaper day one, but again, that's a conversation that you can have with your borrower about whether the benefit is to have the MI for 2 years and be able to cancel it, because we are in an appreciating market, so they'll probably likely reach 20% pretty quickly. The other thing is if they're starting off with a low LTV, like an 85% LTV, that MI is going to amortize off very quickly. So at 85%, it's generally about 2 years, sometimes 3 years before the MI automatically drops off. So they'll have a reduced payment without having to do anything.
Right, you can also use it as a selling, either way you can use it as a selling point. You can use it as a selling point that that this guarantees almost a lower rate at this point. Because I think when you get your docs, when you're doing just any other regular MI schedule, it prints out the entire MI schedule for them and shows them that based on even the market not moving at all after 2 years and providing an appraisal and going that route, that after a certain amount of time, this is what your payment's going to be. And not only are you giving them a low rate to begin with, but then you're also going to be able to guarantee a lower payment at this date.
Yep, and I think that's a great opportunity, since all of you are long-term partners with your borrowers, you're doing purchase business, you'll probably have repeat transactions with them. You definitely want to be sure that they are, satisfied that they've gotten the best deal out there so that they can refer you to their friends and families. And of course, the realtors will be happy because you closed their loan, and they'll also give you repeat business. So I think that those are just some options that can really, like I said, help you differentiate yourself from your competitors, because they're probably not talking about all of these different options. And because of your partnership with Pinnacle Capital, you have them all available, and a lot of originators out there don't right now.
So just to reiterate, because I'm familiar with Radian, do you guys have a 45 DTI requirement as well? Or is it
no? If you go back to our GO guidelines, we follow findings. So if you have an approved eligible, we will follow that. I really don't see too many DTIs above 45. On occasion, I see them up to 50 on LP loans, but very rarely. I don't even think you can get them now on DU.
We just got one at 50 back in. So
the answer is no. We don't.
Okay.
That was an FHA though, Rich.
Yeah, I know, but if we can convert them to a conventional product, because they have 5% down. For MGIC though, you guys go down to 620, right?
Yes, we do.
Is that at certain LTVs, or is that?
No, it's across the board.
Oh, interesting.
Yeah, but when you swap that, Rick, just to save you some time, when you swap it from FHA to conventional lending, it's not going to approve it at 50 with a lower FICO score like that.
Okay. Yeah, no, this client
No,
actually
it's
has
that
16.
DU approval, but we run them all the time. I mean, internally, we're running DUs all the time, and there's certain triggers that just go from approved to ineligible very quickly, and being at a 50 DTI would be a trigger for sure.
Right.
Yeah, I really haven't seen too many approve eligibles at really low FICO scores above 40, 45. I would kind of go in eyes wide open with that one.
Yeah, well, we can cut
Just because they'll-
well, if we switch it from FHA, then the MI gets cut in half, right? So, and then we can use LPMI if it comes out cheaper to lower the payment. It'll probably be at like a 47 or 48. So, this is good stuff. I mean, I didn't know that you guys didn't do it. That you guys could actually honor the DU findings. Are you guys cheaper than Radian in general?
We're exactly the same as Radian in general.
Okay. And you lowered your MI rates recently on December. Is that what I saw?
Correct. Yep.
Why is that? When
So
FHA
they're the same, Radian, Rich, but this is an important part I want to just throw in real quick. They're the same as Radian, but Harper's on the phone giving us the training, so it's nice if we can go in, if the price is the same and you guys are happy with everything that we're looking at. If when you print out that MI quote, we'll go to MGIC. So if they're exactly the same and one person's providing a service for us, and it's kind of, it's nice if we go ahead and throw that extra piece of paper in the file so that it for sure goes to Harper for doing training and stuff for us.
Yeah, no, I don't have a problem with that. I was just wondering because I know Pinnacle used to be Radian Platinum, and I never quite figured out what that meant. So I'm just wondering. I think it meant like the single pay MI option was available, but since Harper, since you allow single pay, do you guys have a minimum credit score for single pay?
No, like I said, we'll follow findings. So as long as you've got an approved eligible, we'll go all the way down to 620 FICO, and we'll follow findings on just about everything else.
Okay, because I know Radian only does it on a 680 score, so I just want to make sure because we saw a lot of the MI buyout program, what we call it.
Yep. No, we're good. We're good.
Okay.
So with that, I think the only other thing I have is just to support you as our partner, and again, thank you so much for giving me the opportunity to get to know you and to explain the benefits of mortgage insurance and MGIC. By working through Pinnacle as one of our partners, we do offer training. So if you are not familiar with the webinars that we offer, we do offer some tax return analysis training, and I will go back out here to that just so we can see it. Maybe. But we offer a lot of core courses that can be very helpful to you as you grow your business. So feel free to use MGIC for your training needs. We've got tax return analysis, we have appraisal analysis, we have processing, so understanding the 4 C's. We very often will have special events like working with realtors, using social media to market. Sometimes we have guest speakers like Rob Chrisman or Chris Thornburg, the economist. If you haven't heard of Chris Thornburg, that was great. And of course, everyone knows Rob Chrisman, especially in this area, as a true market expert. So feel free to reach out to me. I'd be happy to put you on my distribution list if you want to get updates from MGIC. And I know Cassie will pass those along also. So with that, like I said, I want to respect your time. I'll open it up for any questions that you might have.
Can we get copies of the slides?
Sure, yeah, I'll be happy to send that to you. And I told Cassie I would send them to her too, so we'll get them out to you. And feel free to reach out to me or to Kim if you have any questions. And with that, Cassie, thanks again for having us, and Rich, and I will get an email out to you all.
Thank you, Harper.
Thank you so much.
All right,
Appreciate it.
thanks a lot. Have a great afternoon.
Okay, thank you.